Penny stocks are where the craziest volatility meets the biggest opportunity, but only if you actually understand what you're buying into. Today, I'm breaking down 5 stocks that are under $5 a share that have real businesses, real catalysts, and massive upside potential heading into 2026. High risk, high reward, not financial advice, just where I see the best asymmetric setups right now. Let's jump in. The first stock on the list is Plug Power Inc., which is currently trading at just under $3 a share. They are building hydrogen fuel cells and green hydrogen plants used to replace diesel and fossil fuels in forklifts, trucks, and industrial energy systems. Not only this, but they provide hydrogen storage and refueling infrastructure. At around $3 a share, Plug trades like it's on life support, and we've seen it after the last few years has gotten beat down. I remember it being one of the main stocks being talked about on Reddit back in 2022, 23, and now it's continued to get beat down. But there was recently a $1.66 billion Department of Energy loan guarantee, which was a major vote of confidence. That funding backs its green hydrogen plants in Georgia, New York, and Texas, which could make Plug one of the few U.S. companies producing hydrogen at scale. As we can see here on the screen, the 1.66 billion loan provides Plug Power with a clear low-cost capital source to fund its expansion plans. This is very important because their market cap is only at 2 billion, as we can see here, and 2 to 3 billion. And this is against a multi-billion-dollar project pipeline, which gives them huge operating leverage. Not only this, but having the DOE support, it gives them a huge amount of fear that was previously in the stock. It's all taken away. Also, I want to bring out that they have big customers like Amazon and Walmart who are already using its techs inside their logistic fleets. So the key things to watch are the cash burn and gross management improvement through 2025. And if I think if Plug can turn operationally positive and commission plants on schedule, the stock could easily double from these levels within a couple months. The next stock on the list I have is Commerce, currently under the ticker symbol CMRC, which was former BigCommerce. And what they do is very simple. They basically run a cloud platform that lets businesses build and manage online stores. Think of it as a Shopify competitor that focuses more on mid-sized and enterprise clients, selling across multiple channels like TikTok, Amazon. I've seen them on Google Shopping, like the ads on there. After the 2025 rebrand from BigCommerce to Commerce, the stock fell after because investors were worried about it. But I think the financials are quietly getting better, and I think this is mainly brought up from their shift from small shops to enterprises, which means there obviously is going to be fewer customers, but longer contracts and higher revenue per user. This will cause them to increase their gross margin and operating income for 4 straight quarters. Not only this, but they're the first company to be integrating AI tools for inventory and product optimization, which Shopify is still falling behind on. And I think it's a trend that's becoming to become very big in e-commerce. And all this shift has caused an increase in a lot of different things. And I think a catalyst to watch will be the strong Q4 enterprise signups and guidance towards profitability by 2026. Me personally, at $4 a share, I see a path to $10 if they're able to execute on these plans. And when we look at a stock like Shopify, which had just grown over 60% year to date and has a market cap of over $224 billion, it is very easy to see how this is not going to be the only competitor in the scene. And we already see with this company trading at one half of the net sales to revenue that Shopify is sharing at. So I think this is a lot of upside, especially once they can turn profitable and it continues to grow, especially in the enterprise service, which I think Shopify has done a lackluster job with as they more towards they focus their ideas towards consumers more so. Next on the list we got is Fubo, which is the streaming's kind of last fighter. I think it's mainly a sports first live TV streaming platform, which is essentially a digital cable bundle with ESPN, Fox Sports, and regional channels focused on live sports and better integration that other systems have been trying to get, especially as sports are the most growing market. I know Sunday Night Football is today, and a lot of people look forward to that all day. They watch it all day. And at around $3 a share, the market is pricing Fubo like it's basically finished with only a market cap of just over $1 billion. But management has been able to cut costs and is laser focused on profitability in the next coming years. Why I personally like it is that their subscriber base and average revenue per user are both trending upwards over the last quarters. Not only this, but there's the sports centric niche means they're not competing head to head against huge competitors like Netflix, Disney, Hulu. They're really in their own lane here, and they're one of the only entertainment providers that is solely focused on sports, which I know a lot of other companies are trying to get into. I know Netflix just bought WWE rights. YouTube has the Sunday Night Football, and I know everyone's trying to get in on this, but I think their focus on this is going to allow them to credit. This is what the CEO credits the positive adjusted EBITDA to continued execution of their strategic priorities and a core business focused on flexible content for consumers, which leverages the niche demand for sports centric streaming. In my opinion, if Fubo's posts a net income positive quarter in 2025, this will quickly skyrocket up to $6 a share or higher as the shorts cover. It's one of the most shorted stocks on the stock market. There's also M&A optionalities, and a bigger media group could pick it up for its sports audience. I know there was talk about Warner picking it up, maybe Paramount, and this is a very ideal situation where you buy very low here, and even if it gets bought out, you're still going to be making a premium on your shares. The only risk I really see is there's rising sports rights costs and limited pricing power, but I'd keep positions small and take profits on spikes and watch for any news that are coming out from the stock. Next on the list, we got BlackBerry. I know a lot of people haven't heard that name in a long time, but BlackBerry is now pivoted its company and it's developing secure software for connected devices and automotive systems. Its QNX operating system is used by most major automakers for its vehicle safety and informate platforms, as we can see here on the screen. And it is currently trading at just under $5 a share with only a $2 billion market cap. The company has been restructuring into two segments with cybersecurity and the IoT, which is led by QNX, and it's used in over, I'm pretty sure, 240 million cars in the world, which is very, very good for a company of this size. And I think it's going to continue to grow in the future as it gets more partnerships and more deals. Personally, I like it here the most because the IoT segment is growing double digits annually. Not only this, but the company plans to spin off cybersecurity to focus on auto and embedded systems. With this, they also have deep OEM relationships with companies that are legacy automakers in the United States as well as nationwide. They have partnerships with companies such as Ford, GM, Toyota, and more. So even here, where we see, I misspoke, where it powers more than 255 million vehicles worldwide. This includes applications in infotainment systems, advanced driver assistance systems, digital cockpits, and telematics. The company is positioned to grow QNX profitability by leveraging its strong market presence and favorable industry trends. BlackBerry has two main growth, as I was telling you guys, and that will continue to grow in the future. But I think right now you have to watch for this IoT division to become profitable by late 2025. And if they pull off the spinoff, sum of parts I think will re-rate it to $8 a share, and I think that's very realistic. Last up on the list, we got Nano Dimension, which is an Israeli company that makes industrial 3D printers for printed circuit boards and electronic components used in defense and semiconductor prototyping. They also own subsidiaries in micro robotics and additive manufacturing software, which is very interesting. And it was a stock that I was in for a while. It has been a popular stock on Reddit for many years now. I remember when I was first getting into the market in about 2020, it was one of those stocks that people were saying is a must buy. And this was when it was still at $7 a share. So now it has fallen even further, which obviously it's a caution, but also I think it could be showing an opportunity because at $2 a share, Nano Dimension's market cap is only 300 million, but it holds around 900 million in cash and investments. So the market is pricing it roughly at 1/3 of its cash value, which is very extreme for a company that is positioned to grow and has many different subsidiaries which it has been able to grow out to. I recently exited my position on a loss, about a 20% loss. It wasn't a huge position, but I've been looking for a better entry, and I think right about now is a pretty good time to be it. And I think I like it here because it's the rare penny stock with a net cash balance sheet and defense grade IP. That their patents, their ideas, their all their stuff is it's multi-layer PCs, antennas, and sensors, and it uses proprietary nanotechnology based conductive and dielectric inks in its machines, which no other company has. Not only this, but they also have been running share buybacks and strategic acquisitions, as I said earlier. And this was shown through its IP portfolio acquisition of Desktop Metal and Mark Forged in April 2025. And I think activist investors have forced management to get disciplined about its capital allocation, and it still has a lot of cash, which I think will allow them to continue to grow. And this market is still very early, which means it has a lot of time to grow in the future. And this is a pure asymmetric bet where you're paying basically 30 cents on the dollar for cash plus optionality from its defense contracts. And if management executes even modestly well, I think that Nano Dimension could double or triple from here. And I think some of the risks are obviously that there's the past execution failures and the boardroom drama that we have seen over the last few years, which has caused the stock to continue to tumble down. But if they want the cash, the discount stays. But the margin of safety is rare for a penny stock that we've seen. And I think it's very interesting to see that this is going to continue to grow probably in the next couple of years if we can see anything in the future from these companies. And that brings me down to the final of the list. My 5 penny stocks for 2025 is Plug Power, Commerce, Fubo, BlackBerry, and Nano Dimension. Each plays in a different sector, but all share one theme, and that is asymmetric upside from depressed valuations, which they are now. I don't expect all 5 to work, but if 2 or 3 double while the rest stay flat or just kind of stay where they are, I think that's a solid return for a small speculative portfolio slice. And always size positions carefully, take profits when you can, and remember these are not set and forget investments. If you found this helpful, drop a like so more people can see it. Make sure you guys subscribe for daily stock breakdowns and comment which penny stock you're watching into 2025. Thank you for watching and have a great day. Peace.